Good morning, and welcome to the Energy Perspectives Group webinar hosted by PHX Minerals. This event is being recorded. During the presentation, all participants will be muted. If you have any questions you would like to ask, please type them into the chat feature. We will read and answer questions at the end of the presentation. Thank you so much for joining us today. Now here's Dan Steffens, who will introduce today's speaker.
Okay, I still see we got the number of participants is growing by the second. So anyways, I'll wait a minute here to get most of the people on. But anyway, our speaker today is Ralph D'Amico. He's the Chief Financial Officer for PHX Minerals. And PHX is one of the companies in our small cap growth portfolio. I added them to the portfolio after they hosted a luncheon for us here, and I was very impressed by their business strategy. I think that was like 5 or 6 months ago. But anyway, Ralph joined the company on January 2nd, 2019, and he was hired as the Vice President of Business Development and Investor Relations. So giving presentations is right in his job description from that day till March the 9th. And on March the 9th of 2020, he was promoted to the company's Senior Vice President, Chief Financial Officer, and Corporate Secretary. Prior to joining PHX Minerals, he served as Managing Director in an energy investment banking group at Stifel Nicolaus and Seaport Global Security. Prior to that, he held positions in investment banking practices at Jefferies, Friedman, Billings, Ramsey, and Solomon Smith Barney. So a lot of experience in evaluating companies, and especially in the energy sector. He holds a bachelor's degree in finance from the University of Maryland and an MBA from the George Washington University. Okay, I'll now turn the controls over to Ralph for an update on PHX Minerals, and then I'll come back on after his presentation and we'll get into Q&A. If you have any questions, please post them to the chat box. You can open the chat box by taking your little pointer down to the bottom of the screen and then just click on chat box and you can type in your questions there. Okay, Ralph, it's all yours, buddy.
Thanks, Dan, and thanks everybody for joining us today. As Dan mentioned, I think we presented to this group. Oh gosh, I think it might have been maybe April or May of last year. It was quite a while ago, and over the last 9 months or so, a lot has changed at PHX. A lot of the things that we said we were going to do, we have done, and I think it's been very, very positive in terms of the results that we've seen since then. Just to give you guys a quick background on who we are the old Panhandle Oil and Gas. The board decided to change the strategy to go back to the company's roots of focusing on minerals and royalties at the beginning of 2020. Replaced the CEO and the CFO at the time with Chad Stevens and myself. And since then, we have been focused on high grading the asset base, effectively selling non-op working interest, redeploying that cash flow into minerals and royalties ahead of the drill bit to generate which generates returns in excess of our cost of capital. And also opportunistically selling some of the non-producing minerals that the company acquired, over 100 years, almost 100 years of its existence. A lot of it are in areas where horizontal drilling is not doable, or in areas that are not actively being developed in today's commodity price environment. So our strategy was, if we can sell that and redeploy it into near-term development in high growth areas, right, that's going to benefit. It's going to increase cash flow and benefit all the shareholders in the long run. We continue to maintain a pretty clean balance sheet. We're conservative by nature when it comes to debt. We try to run debt to EBITDA in the low 1x on a trailing 12 months basis. And we opportunistically hedge as well. Probably wish we had put on more hedges last year, but the good news is, as we speak today, we are selling some gas at $6 still. with the with the hedges that we put on for January, February, and March of this year that we put on 6 months ago. So that's hopefully we get back to that point soon. But even if we don't, we've built the business to be able to generate pretty good cash flow and free cash flow that we can reinvest or pay out in dividends and return to shareholders, even in a $3 gas price environment. I think we talked about this on this page. You can see that, we're generating, around 20% free cash flow yield. I also called that discretionary cash flow. When we tend to pay out, the dividend roughly equates to about, 10-12% of that free cash flow, and we're reinvesting the rest into acquisitions that have significant upside potential as they're brought online, primarily in the Haynesville and the Scoop the Scoop play of Oklahoma under Continental Resources there. Again, this is a new slide that we did not use last year. This basically goes through, here are the goals that we set in at the beginning of 2020, and here's where we are, to date. Significantly increased the royalty production volumes. What's interesting about that is that about 90% of that growth comes from assets that we purchased over the last 3 years. The legacy Panhandle mineral position was growing in the, call it, 5% a year over year basis. So, that 85% total growth from 2020 to today is directly correlated to all the acquisitions that we have done immediately ahead of the drill bit. At the same time, we've built a nice inventory of 2,000 drilling locations mostly in the Scoop and the Haynesville, and those really, we're converting about 300 wells a year. So you've got 7-8 years of inventory there, where even if we stop buying today, those wells are in the core of the core, and they're going to continue to be developed. Clean balance sheet, as we stated, and the bottom of the page, I think that's the one that we're the most proud of. We're big believers in measuring return on capital employed. For 2022, it was 16%. That's compared to 0 in 2019, and before Chad and I became the management team in 2020, which had, obviously was affected by the by the pandemic. So this return on capital employed is the key number that we live and die by in terms of measuring how successful we're being. And by how successful we're being, it really is directly correlated to the acquisition program, because if we're not making good acquisitions, now it doesn't matter what commodity prices do, that number will not go up. Next page just kind of shows, on a quarter-over-quarter basis, you can see what's happening in terms of commodity prices, top line revenue and adjusted EBITDA. What I think is interesting about the top portion of this page is that in the middle of 2020, the commercial bank that we had at the time made us hedge a significant portion of our existing production in 2021 and 22 at $2.90. So what you see on the top right side of the page actually includes a lot of gas being sold at $2.90. And, one wonders what those numbers could have been even higher, with gas averaging $5 or $6 in calendar 2022, if we had not been forced to put those hedges on. Same thing with the bottom of the page. You can see that, the company was treading water from a return standpoint. And, since 2020, it's night and day in terms of generating not just cash flow, but net income and positive return on capital employed. From a balance sheet standpoint, you can see that, as I said, we try to run a very conservative balance sheet. We think that in the commodity business, where you have this, particularly in natural gas, right, it can get whipsawed a little bit in terms of the cycles, right? Running a strong balance sheet with ample liquidity, not just as the prudent thing to do, but it also creates opportunity when there is a downturn where you can actually step into the market and buy properties even cheaper, where nobody else that may have levered up during an upcycle would be able to do. So that's kind of how we manage the balance sheet there. Last year we did not provide an outlook in terms of production and some of these key metrics that you see here on page 9. We think with the quality of the assets that we have, we can make some reasonable estimates in terms of the timing of development, right? All of these volumes are coming from wells that are currently being worked on by operators. So, there's a pretty high degree of confidence that they're going to get brought online. And so even at the midpoint of the 2023 outlook, it's 20% growth in royalty production over calendar 2020. You see that working interest is coming down. That's from the sale of the non-op working interest. We did close at the end of January on the sale of the Eagle Ford and the Arkoma Basin assets that had very little upside and were low margin assets, had a little bit higher LOEs than frankly we even would have liked. So that's why you see the drop there. So on a total production basis, it's interesting. 23 is really an inflection point because if you look at the top line production, it's relatively flat. But the sale of the working interest, if you look at just the total production, it masks the growth in the royalty volume. Working interest is only about 10% of our business now, so it's not necessarily very material. So when you look at, a year from now, when you're looking at 24 over 23, not just does the mineral and royalty production grow, but the total production grows as well, which I think just from a headline standpoint is going to make things easier for folks to understand. And then you see all the other metrics there. We try to make it fairly easy to try to build to try to make people that that are interested to build an Excel model that tries to predict cash flow. You can take these numbers, you can put in whatever assumption about commodity prices you think will happen, and it should spit out a range of cash flow for 2023. In terms of page 10, where our assets are, you can see highlighted in blue, Scoop and Haynesville are really the core areas that we're operating in. The red dots outside of the blue are legacy assets that the company had, over, as I said, almost 100 years of operating history. You can see who the top operators are. In the Scoop, it's Continental Resources. In the Haynesville, it's Chesapeake, who we're big believers in terms of growing their production to kind of meet the LNG demand that's going to come out of the Gulf Coast. Paloma is a private equity-backed company that operates both in the mid-continent there in Oklahoma and also in the Haynesville. Trinity is the natural gas drilling arm of a public utility called NextEra, and Aethon is a very large private operator in the Haynesville as well. So these are top operators. We think they do a good job from an engineering standpoint. They know how to drill wells. They know how to produce them appropriately. And they're well capitalized and have continuous drilling programs in place, which as a mineral holder is, time is a risk, right? So to stay with operators underneath operators like this is one of the key underwriting metrics that we look at whenever we consider acquiring additional minerals. Reserve growth, this is important. This is how we're creating value. You can look at these are just royalty volumes, and you can see that they have continuously increased, as has production since 2020, right? And what I think is also important is if you look at the light blue on the top graph and the gray, those are wells that are currently being worked on or currently being looked at for permits, right? And that continues to grow. which shows the repeatability of the business. And that's where the future cash flow of the business running through the financial statements is going to come from. Speaking of reserve value, what we've tried to do here, if you look at the middle column, strip pricing, and this is it's a little bit dated from when we put this presentation together. It had strip pricing as of January 23rd of 2023. But what this basically shows is that PDP is PDP. We all know what that is. Wells in progress are, again, wells that are being drilled, or they're drilled uncompleted wells waiting to be completed, or they've already been completed and they're waiting just to be hooked up to a sales line. You get to almost $150 million of value versus our, I think our market cap today might be around 110, and add the debt to it, and you're probably in the 135, 140 range, right? So we're trading right at that PDP, and the SEC will call these wells in progress PUDs, but they're actively worked on. So if you look below that, you look at the near-term locations, right? We call them probables because we don't control the timing, right? And so the SEC says that unless you can show me a drilling schedule that says the wells are going to be drilled in 5 years, you cannot call it a proved undeveloped location. But we do a lot of work in understanding where these locations are. And the vast majority of these locations are actually offsets to existing production. So it meets the technical definition. And they probably are PUDs on the operator's books because the operator has the drilling schedule. As a mineral holder, we don't have the right to see that drilling schedule. So we can't call it a PUD, but that's real value, right there, that effectively doubles the value of the proved reserves of 150, as you see there. So we think there's substantial upside. I guess every management team thinks there's upside to to their stock price, but I guess we're no exception. We believe that that's the case as well. Page 13, this is just an inventory of where all of the, where the upside is, right? So I remember I talked about the 2,000 drilling locations, right? So if you look on the top of this page, right, about 1,000 of them are in the Scoop. The majority of those are going to be in Springboard 3, which is Continental Resources' crown jewel. The economics in that play are better than anywhere in the Permian, according to what Continental has publicly stated. And then you see the other locations as well. So that's where, even beyond the Haynesville, that's where, the growth in 24 and 25 are going to come from, is going to be from the Scoop area. As I said, we're converting about 300 gross wells per year. That's what we did in 2022. On, net to us, right? It's about, about 1.1 net wells to us. But, as we continue to focus on the core of the core, what you really see is a trend of, people will be active regardless of commodity prices on our minerals, right? So the strategy is, if there is a disruption in pricing, the last rig laid down would be the ones on our minerals, because our minerals provide the best economics to the operators. And you can see this page basically shows the inventory. These are those wells in progress that I talked about. So, to achieve that growth in 2023 on the royalty side, right? We need another, about 1.07 or so net wells, right? And you can see the inventory as of December 31st. That's the inventory of wells that was actively being worked on by operators. So, there's no speculation of an operator will need to come drill on acreage that hasn't yet been identified, right? All of our 23 volumes are PDP or wells that are currently, or locations that are currently being worked on. This is just our acquisition program. Obviously, we spend about 90% of our free cash flow on growing the business, that creating value. It has to exceed our cost of capital, right? And it has to generate an outsized return. And obviously in 22 we spent $46 million. That's more than our cash flow, but we divested a lot of the working interest, right? So we redeployed that cash. We also sold some open minerals, and we had as the quality of our assets and our collateral package to the commercial lenders has grown, they've made more capital available to us. We don't draw all of it because we want to stay in that low ones debt to EBITDA, but it is there. And that's what, that's why you see the $46 million. And the opportunity set, to be a consolidator continues is huge. Pages 17 and 18 just kind of visually shows you where we've focused our acquisitions. When Chad and I came on board, we owned 0 acreage in the Haynesville, and today we own 6,500 net royalty acres. That accounted for about 40% of the production last year. So when I talk about the growth rate coming from the acquisitions that we made being converted to production, this is what I mean. At the end of 2019, there were 0 acres owned by the company in this area, and today this area is 40% of our production. We'll skip this page, just some highlights of where we're operating. This is a snapshot of the scoop, 4,000 acres there. That's where the the vast majority of those 2,000 drilling locations, the 1,000 in the scoop that I talked about, are coming from. And this is Springboard 3. You can see the number 3 there. That's the orange and red. This is a close-up of it. This is that crown jewel that Continental talks about. And if you look at the map you see the little number 3 and the little number 4. Those are all Continental wells that they are in the process of completing as we speak. There are, I believe it's 16 or 17 wells between number 3s and number 4. They're stacked on top of each other, so you can't really count the sticks. But we think that those are going to come online here in the next 6+ months. And I mean, to a degree, the secret's already out that this is a real core area for them. But once the results of these wells come out, I think there's going to be even more focus there. And I believe it's number 1, this Billy the Kid well, which is not operated by Continental, but it is one of I think it is actually the highest performing, best performing well in the history of Oklahoma. So, sort of think about that, right? I mean, all the years and all the technology that's gone into Oklahoma as a state, that's the best well that's ever been drilled in the state. I wish I owned more of it. I only own 0.06% of it, but but the geology is pretty consistent within the blue outline. This is just a little bit more in geology, the Sycamore and the Woodford and how they're drilling the Springboard. And this is just an overview of the team. We run, all of these people we have 22 employees, half are accounting, half are technical, once you take out Chad and myself. Very accomplished people, very capable. They've all been, you can see that they've all been hired within the last few years. It's a real high grade to what the business was and what the business is today as we've continued to transition it. And they deserve a lot of credit. Quite frankly, we would not be here without them. And to those that are interested, we have 3 research analysts that cover us. You can see their names on here. And here's our hedge position. So, this is, by way of example, Dan, if you look at Q1 23, that's January through, that I mentioned, January through March, right? You can see the volumes that, we had done a lot of costless collars where, the average floor is 525 on 390,000, MMBTU. So, we're pretty well protected, even during this downturn. Obviously, we're not immune to it, but I think we've done a pretty good job of protecting ourselves and frankly maintaining the upside, right? Because as you can see here on the ceilings, right? I mean, we think the long-term gas is at a minimum $4 to $5, right? And we've got upside, through significantly higher than that. As the market kind of tends to swing both ways up and down, right? So pretty good downside protection and exposure to the upside. And that's all I've got, Dan. I don't know how
Okay.
much time that was, if it was too
Yeah.
long or too short, but
Good. I've got some questions of my own here, and some of them they read right into the ones that they posted. One of the general questions that I have, with the recent pullback in natural gas prices, how has that impacted the drilling activity, specifically in the Haynesville? And then I guess specifically the drilling and completion activity on your minerals in the Haynesville.
yeah, no, that's a good question. So let me go to this map here to kind of give you let's just help direct you guys. So what we hear from talking to industry folks, obviously we don't operate, but we talk to lots of operators. The private companies, the private equity backed companies, what we're hearing from them is that they may drill and wait a couple months to actually put the well on sales, right? Because it starts off with real flush production, and it then declines hyperbolically, right? So we're hearing from them going, look, if we can wait until the second part of the year, right, and get $3.50 to $4 gas, as opposed to putting a well online today and whatever gas is at today, $2.70, right? They will do that. The public companies are actually saying something slightly different. If you listen to Southwestern's earnings call, they basically said, we're going to put them on production as they come on. They're not waiting, right? And if you listen to Chesapeake or Comstock, it sounds like they're giving themselves some flexibility to do one or the other, and they're kind of talking about flat to slightly higher volumes coming out of the Haynesville. And because of the decline rate of the PDP there, right, they can't slow down that much and still keep that production flat year over year.
Yeah, we've been talking about this on our chat board and stuff. And, people are concerned because the gas in storage is, a couple 300 BCF above the 5-year average. And one of the things that I try to make a point of, these upstream companies, they will adjust their completion activity.
Yep.
When I was at Hess, we choked back wells every summer just to say, we're not going to sell the gas in the summer. We'll just wait till it gets higher in the winter. One problem I do see is if a lot of them do that, then they'll say, okay, now let's go complete them all. Maybe they won't be able to get a completion crew. That would be the one downside risk. But
that's right.
Yeah, one of the companies we follow that's always also in one of our model portfolios is Silverbow. And they said they were moving their rigs out of the gas area, and they were moving to more oily. And then I think they're going to have 6 or 7 duck wells, and they're just not going to complete them until the gas price gets up maybe even $4 or something. But I think this perceived imbalance in the gas market is going to be very short-lived because the decline rate of these shale wells is so high. It'll adjust very quickly, just if they just slow down their drilling programs a little bit.
Yeah, I mean, if you look at the Haynesville, the rig count across the entire Haynesville. So let's look at this page. This is the broader Haynesville, like in white.
Right.
I mean, I think it topped out at 75 rigs running. I think we're still in the high 60s. So, maybe people are just kind of working through the rig contracts in terms of the operators. We'll see, because people keep talking about dropping them and dropping frac crews, but the numbers do not yet show this.
Yeah, I think most of them they'll drill and case the wells.
Yeah.
They might put off the completion for a while because, like you said, these wells come on, especially the Haynesville. The Haynesville wells are just fabulous. Comstock reported a recent Haynesville, and I think it was in Texas, so it was in a newer area, and its 30-day IP rate was 42 million.
Yeah, it's crazy.
Unbelievable. But the average Haynesville well, the average comes on at over 20 million a day.
Yep.
I mean, these wells pay out fat. If you get up to even $3-4 gas, you're talking payouts in 6 months or less on these wells. So
That's
it can
right.
be real flush and real good.
And the break even, honestly, I mean, it depends what kind of returns these operators want to generate. I mean, there's been cost inflation, obviously, for, it doesn't affect us from a dollar standpoint, but it affects the operators, and then maybe, it reflects how they think, right?
Right.
But the break evens here, I mean,
They're
there is
fabulous. Yeah.
everywhere where we are, the break evens are, pretty much, below 250. A lot of it's around $2, even with the recent inflation in operator costs, right? So,
Yeah.
which is part of the reason why we like this. But what I'll say also is, look, I mean, the good news is, we kind of have like a balanced approach, right? So if you look at the scoop, right, and this is just the scoop, although it doesn't even include what we own in the stack, but in this area, it's you got 3 streams of production, right? I mean, you're gonna get a third of the production is gonna be oil, and the gas is gonna be 1,350 BTU gas.
Yeah, it's real high in liquids gas.
That's
there.
exactly right.
Yeah.
And so, notwithstanding what happens in the Haynesville, right?
Yeah.
You're gonna have, at least as it pertains to us, right? Any potential slowdown in the Haynesville hopefully gets picked up by increased activity here, because NGL prices are holding in there as a percentage of WTI, right?
Mhm.
And WTI is still in there, so these are highly.
Yeah, go to your next slide that shows that where Continental is.
Yeah.
Let me tell you guys that are on the call for something. If Harold Hamm of Continental says this is their core of the core, they're going to go in there and they're going to do what I call is mowing the grass. They're going to build pads and they're going to just move rigs in there and drill, baby, drill. Because these wells, somebody asked, did you say is a scoop better than the Haynesville? I will tell you what's in green there are better than the Permian. What's in green there, the payouts are like 4 or 5 months at today's oil prices. Those are fabulous wells that they're drilling in that area. Like you said, if that's the #1 well ever drilled in Oklahoma, think what that means. That's incredible.
Yeah.
So these guys they're gonna move in there, and you're gonna see a lot of rigs drilling in that. And is most of it held by Continental?
It's most of it is Continental, and then you see Camino in there. That's a private equity backed company. Citizens is another private equity backed company. Believe it or not, Marathon's got a little bit of acreage here, and Ovintiv has got a tiny little bit of acreage here as well.
Okay.
But it's Oklahoma, right? So it's a lot of it's commingled, right? And with forced pooling in Oklahoma, right?
A lot of work.
My guess is Ovintiv and Marathon aren't going to drill any wells. They may participate as a non-op, but Continental is going to propose a well on them, and they're going to end up drilling it.
Yeah, I tell you, if you're a small working interest owner in an area where Continental moves in and they decide to just go crazy drilling it, you better have a deep pocket to keep up with those AFEs, because man, they can get going. I know. Now this was when they were in Canna. A guy that I know that was a very wealthy guy held, maybe like an eighth or a quarter interest in an area where in Canna, and it was also I think it was Deep Bossier gas wells at the time. And man, he was getting 2 or 3 big AFEs for his share was $1 million plus like every month. And it was just eating him alive. But the wells came on strong. I mean, it worked out for him. But anyway, good stuff. Well, let me go on. There's a question says, why is working interest royalties better than non-working interest? Which has a better return on capital employed?
So that's a good question. So here, let's go to this page here, because I actually have a little description of, is it this one here? No. Okay, so think about, let's think about just a barrel of oil, right? So a operator is going to produce a barrel of oil, right? So he's got to drill it on, so somebody else owns the minerals, and let's say that it's a 25% royalty, and let's say that I own all the minerals in that unit, right? So he's got to pay tax. After tax, he's got to pay me right off the top, right? 25% of the revenue, not cash flow, the revenue that he generates, right? Then with the remaining 75%, he's got to cover all of his costs, right? And so I got to pay tax as well, right? So after I pay tax, and both of us have to kind of pay to get our oil to market, right? So the gathering charge, basically, right? So for every dollar that I receive, I get to keep, let's call 80 to 85 cents. For him, right? For every dollar that he receives, right? Or for every dollar that he produces, right? 25 cents has to go to me. Then he's got to go pay tax, and then he's got to pay to operate that well. He's only going to get to keep like 30 to 40 cents. So there is the margin, the cash margin that a mineral holder keeps is double on average what a working interest guy gets to keep. The other thing is, they're susceptible to cost overruns. I mean, we're both, look, if you drill a dry hole, I get nothing either, right? But I only lose the cost of whatever I bought the minerals for. He loses the lease cost. He loses all the money that he put to try to drill that well, right? So he gets a lower margin, and he's taking all the risk effectively. Cost overruns, anything of that nature, right? So on a risk adjusted basis, right, we think that we think the minerals are the place to be. I mean, I'll tell you, you can look at my financials. So this is all public data. If you look at if you look between the third quarter and the fourth quarter of 2022, last year, right? Even though we sold the Fayetteville working interest in the third quarter, our LOE, because of all the inflation on the remaining non-op, actually went up, even though we had sold like 700 wellbores the prior quarter. And so, now that doesn't affect my mineral business, but imagine what that does to somebody whose entire business is working interest.
Yeah, I notice your work, your LOEs going way down from 2022 to 2023 because you sold all those working
interest. Way up from 21 to 22, even though we were selling wells.
Yeah. So, and that kind of leads into one of my questions was, how do you market your gas? Do you just market your gas with the operator?
Yeah. So, and this is true for all mineral holders. Basically, the operator has to treat our gas the same way he treats his own. So, if he's selling it into XYZ pipeline for whatever, and he gets, let's say $3, he's got to give us $3. He can't, pay us less.
But if he's able to like take advantage of some real high spot market prices, I know Comstock has been able to do this in the past. Let's say Comstock makes a deal to sell directly to some of the LNG exporters. So you participate in that.
We participate in that. So
that's fantastic. That's good news, man.
Yeah. So said differently also, like if you all remember, I live in Texas, right? So if you all remember the freeze from, was it February of 20?
Yeah. The Winter Storm Uri.
Yeah. I had a nice flooded bathroom because of it. But anyways, the result of that was, our Oklahoma gas was selling for, like a 50% premium for a 3-week period, right?
Well, Comstock during that winter storm, Comstock sold some of their gas for $50.
Yeah, and so we benefited. We benefited from that as well because the operator did. So
yeah, that's
now
awesome.
they cannot hedge for us, right? So they're
right. You're hedging your own
with
production.
us. We do our own financial hedges, right? But in terms of the market they get in the price they get in the market, they have to treat us like they're treating themselves.
Yeah, and that's something I like to clarify for our members also is actual gas and oil, all production is sold into the physical market. Hedges are paper. Hedges are just settled based on the terms of the hedge, and usually you're hedging against an index price like NYMEX or whatever, or a regional index or something. So they're totally separate. So if there's a big spike in the physical spot market prices, sometimes if the operators don't have all their gas dedicated to a pipeline or something, they can take advantage of the spot market prices. Do you know, Ralph, that in on the West Coast, gas prices have averaged over $10 an MCF for the entire winter?
I
Probably
have
still
seen
are.
that. It's well, there's so much political risk there that
Yeah,
people are turning, making it scarce, right? So
yeah,
that doesn't
we totally
surprise
sold
me.
out. Yeah, when I was we got a call one day from John Hess, and he said, "I want you to sell everything we have in California." Why? I don't care. But he had just come back from some meeting out there and said, "I'm getting out of the state. I can't stand it anymore." So
Yeah.
anyway, crazy. Okay. Let's get through some of these questions. Do your banks still require hedges, and at what level of hedge are you comfortable? You might go to your hedge schedule, because I think it's very
Yeah.
important to see that you got a lot of your hedges are collars now,
Yeah.
so you protect that upside.
Yeah. So we did switch in September of 21. We switched from Bank of Oklahoma, who had forced us to put on those $2.90 hedges that we weren't fans of, and
Yeah.
swap contracts. We hired a bank called Independent Financial out of McKinney, Texas. Part of the bank group is also UMB, which is a Kansas-based bank, and First, which is an Oklahoma-based bank. They've been great partners for us. They understand the business. They let us run the business, right? So yes, there is a hedge requirement, but the structure of the hedges is up to us to decide what we want to do.
Yeah, I see all your 24 hedges are just our collars now. Good.
Exactly, right. So what the credit agreement says is that 45% of our existing production for the next 12 months needs to be 45% hedged, both for each of oil and gas. And then in months 13 through 18, they need to be 25% hedged.
Okay. But you can use collars.
We can use, and that's what we do. And then also, but keep in mind the following, right? So you actually have more exposure to the upside than you think based on that, because if you look at, where's my production thing? Here you go. So if you look at the bottom graph, the royalty production, right? Like if 23 is going to be 20% higher based on the midpoint of that outlook than 22, I cannot hedge that growth, because then I'm naked, because I don't have the physical volumes, right, to back it up. So it's like basically doing a naked short on a stock. You would not want to do that, because the downside's unlimited, right? So theoretically, it's the same thing here. And so when I say that I'm 45% hedged on my PDP, if you blend in some amount of new volumes coming online, all of that is unhedged.
Okay. The next question is regarding M&A. What's the key valuation metrics used currently? What multiple on EBITDA or return on capital employed, or both? Any acquisition opportunities, and what's the current multiples? And a question I have that goes with this is, are you able, or are you considering using your stock as a currency? Would some of the mineral owners be willing to take your stock instead of cash?
So in terms of returns, right? We try to, or in terms of acquisitions in general, one is nothing that we have bought has been from like inside of a marketed deal by an A&D shop, right? We've never bought anything from a data room. These are privately negotiated with aggregators and land brokers that we know.
Okay.
So it passes fewer hands, so there is less of a markup, right? So that's one. The average deal size for us is around 2 million bucks per deal. And so if you think about the competition for those deals, right? For the, because we're small, right? We got a little bit of an advantage because a $2 million deal kind of moves the needle for us, whereas a Sitio or Kimball or any of those bigger guys, right? They're kind of trying to do
Yeah.
50 to $100 million deals, and they're not bothering to go buy the $2 million one. So our competition is generally, family offices, not the other public minerals guys. But we buy slightly ahead of the drill bit, right? So on an average transaction, it's going to be by value, maybe a third PDP, a third is those wells in progress I talked about. There's activity on it, and the remaining third are, what we think are majority of which are PUDs, proved and developed on the operator's books, right? So they come online, call it, within a few years. And what we've stated is we try to average a 20% IRR and a 3 times cash on cash return on those acquisitions. And again, right, there is, once we own the minerals, right, there's no additional cost, right? So when you risk adjust it, right? So an operator, probably needs to generate a 30 to 40% rate of return, but that's because they're taking that much more risk than us, right? Everything else being equal. So our 20% may seem lower than what an operator can generate, but ours has significantly less risk associated with it.
Yeah.
So that's kind of how we look at acquisition metrics, right?
Have you done any business or contacted Resource Royalty out of Dallas? Their CEO is a EPG member, and they got a group of landmen, and I know they got a lot of stuff in Oklahoma, a lot of stuff in that Scoop play.
Yeah, I talk to so many people that sometimes I forget them, but
okay.
But let's shoot me an email later, and
okay,
let me just
I will
match the name against my Rolodex and see if I have talked to him. If not, I should.
Yeah, they put together like private packages, doing 1031 exchanges and stuff like that. But they got some legacy partnerships or something they may want to sell. At some point in time, the investors in those things want to have a big payday, and then they just turn around and roll that profit into their next deal anyway.
Yeah.
So
and we have on a couple of occasions used equity as compensation for to help fund an acquisition.
And
so
that might help you in a negotiation too, because if there's a wide gap between their expectations. I know some of the mineral owners, they don't want to sell out based on 250 gas. They want you to pay them, what happens if it's $5 again or something like that. Well, then if they were willing to take your stock, they get immediate cash flow from that, but they also would have the liquidity of the stock and that too. So it might be a way to, close some deals if they're real bullish on the upside of their area or something.
Yeah,
definitely. So who knows? Let's see. Oh, I see that PHX is retaining 90% of free cash flow to buy more minerals. When do you expect a higher percentage of the free cash flow to be paid out as dividends? What's your kind of goal on increasing dividends, let's say?
That's a good question. So, we have been slowly but surely increasing the dividend, right? On an absolute, so as our cash flow has grown, the dividend has grown as well. In 2020, we cut the dividend to $0.01 a share a quarter because of COVID, right? It's, we've raised it 3 times since then to, I think it's 2.25 pennies per quarter, as our cash flow has grown. And I would expect that we keep on doing that. I think the way to think about the dividend is if we can continue to redeploy capital and generate the rates of return that we're seeing, right? We think that creates more value for shareholders than just increasing the dividend payment. But if for whatever reason, the acquisition market changes, right? And, you know, maybe acquisitions dry up or the market locks up, who knows, right?
Mhm.
Then, then what we do is we either pay down debt, which would be accretive to shareholders, right? Or we increase the dividend. It could be an increase in the fixed dividend. It could
Be
be
variable. Yeah.
a special dividend. It could be any of the above, right? But we're economic, and capital animals, right? So
Mhm. Right.
we're going to do what's best for everybody, because we're shareholders as well. And if we see deals that create value for people, we'll do that. But if those aren't available, we're going to figure out a way to return capital.
Yeah. And one thing I remind the listeners that, PHX Minerals is a new name, but this is a very old company. And so is the board, would you say they're more inclined, they're in this for the long run? They're not looking to build this up and flip the company or something?
I mean,
Yeah.
we're a public company, right? So we're for sale every day,
Yeah,
right?
right.
Theoretically, you could come in and offer me whatever, you should offer me, $50
$8 a share.
a share, Dan. I'll sell it to you.
Yeah, right.
I'll put it in front of the board. So I mean, look, I mean, you never know what because we're publicly traded. I mean, you never know when somebody's going to offer you a boatload of money. You gotta, and it's our fiduciary duty to consider anybody that makes an offer, right? So,
Mhm.
but we're not counting on, that's not a strategy in itself, right?
Yeah.
We're trying
You're
to
not
create
telling people to
value.
come make me an offer or
Yeah,
anything.
we're trying to create value, and whether creating value is making acquisitions that generate the returns I talked about, or returning capital, or selling the company, or whatever it may be, that's what we're going to do.
Well, and as you go back there, you're in chart there where if you keep turning those P2 reserves into P1, and that
Yeah.
year-end reserve report starts coming back up. And I listened to the Range Resources deal, and there was an argument they paid their year-end reserve report based on $90 oil and $6 gas or something based on SEC pricing guidelines. It showed that their net asset value, PV10 net asset value, was over $100 a share, $100 a share. And they're quite, well, those prices are, well, if you're going to make the argument that SEC pricing guidelines are not any good, then why do the banks use them when the prices for the previous 12 months were way down? The way to look at these companies is think longer than the next 6 months. I personally think when we get the LNG export facilities online, I think the price of gas is going to start drifting toward 1/6 the price of oil. Maybe not 1/6, but I think it gets to 1/10 the price of oil. I think sooner or later, with that LNG export capacity, U.S. gas prices are going to be more tied to the global price of gas. Because right now we're kind of a stranded, all this gas, we'd only have so much export capacity, but that export capacity is going through the roof here in the next 3 or 4 years. And so I think you need to think long-term about what are these companies really valued at? And these are long-term assets, especially royalty mineral interests. They're not leases. They're not going to expire. They're held forever. And if you start getting to $6-7 gas price being kind of the floor, that tier 2 acreage starts turning into tier 1 money, and they're just getting better and better. So the long-term outlook for gas, I think, is very, very good.
We tend to agree.
Yeah, I think if you're in
But
it for the long run, this is it.
gas is
Buy guys
also
with reserves.
Gas is a volatile commodity, right? One way or the other. And whether it's volatile between $3 and $6 or $5 and $7, or frankly, all of the above, right? I mean, I think what we've tried to do with the new strategy that we took on when we became the management team 3 years ago was to implement a strategy that could sustain all of that volatility, right? Whether, we can make money at 3, we can make more money at 6. I'd
Yeah.
love to have 6, but I don't need 6, right? And
Oh
and
yeah, because
and
the operating expenses on these wells is so low that the operators are going to keep drilling them. If it, most of the
Yeah.
gas companies I thought they're all in cash costs are only like $1 an MCF.
yeah, so that's what we did. We built it to withstand the volatility and be able to make money,
Mhm.
regardless of what gas prices, are. That doesn't mean that, $2 gas over 3 years, right? If, let's just assume you know, that doesn't mean that I don't have to adjust to it, right? But
Mhm.
we can survive and thrive across all of these commodity cycles, based upon the way that we've designed it. And, and I think probably better so than a lot of the operators out there. Although a lot of the operators have gotten religion, and started running a lot lower leverage ratios as well.
Mhm. Oh yeah. They are. They really improved the balance sheet last year.
Yeah.
So I just have 2 more questions and then we'll call it quits here at about 1 hour. But okay, Bill asked, are the hedges settled at an average price for the quarter or a point in time?
Very good question. So the hedges, the gas hedges settle on the first of the month. The oil hedges is an average for the month. And
Okay.
that is just a way that's not specific to us. That's, so we use BP as our counterparty, but whether you use BP or Shell, I mean, generally speaking, that's sort of a standard.
But it's for like March, you're okay, you have hedges for the month of March. Is that March 1st?
Yeah. So
That's
like,
the
for
date?
example, my March hedges, settled a couple days ago.
Okay.
Yes.
Okay.
And then my oil hedges will settle at the end of the month.
But
the
you're
average
okay.
price.
What gas price would you say net of hedges did you actually receive for January? Can you estimate that? Because it's
No, I don't remember. I don't have that
okay.
off the top of my head. But I mean, look, I think if you look at like,
Because
for
those higher
example,
prices carried up, the price is like $6 what we had, I think the average price for January is going to be over 3. Not on hedge settlements, but I mean just on what people actually
what
get net of
people,
hedges.
but going back to this, it's sort of a related point, which is, the way the hedges settled are fairly, it's fairly formulaic, and I know
Yeah.
exactly how, how it's done because it's just one counterparty. The way that the operators sell gas, right? That's all
Mhm.
over the place.
Yeah.
Right. Some operators sell on first of the month, some sell on an average. And it literally, some have optionality in terms of what pipeline they sell into,
Right.
depending on what
I
the
know
price
Comstock
is, right?
does. I
So
know
yeah.
Comstock's got a lot of
So that is going to be all over the place. So like, my Haynesville realized price, if you look at, the differentials or the realized prices that Chesapeake and Comstock get, and you kind of, or Southwestern, and you kind of mix them together, that's probably the best approximation of my realized price in the Haynesville, because those are the guys that are selling my gas.
Yeah. And Continental's got good marketing people too. They're able to get their production sold
They
at pretty
do.
good
Yeah.
prices. They're in good shape. Okay, let's see. Oh, one thing, we talked about this before we started the call. I noticed there's a big impairment charge of 6.1 million. It was a non-cash expense,
Yeah.
so it didn't affect. And so what caused that, and how is that going to reverse in the first quarter? Let's say?
Yeah. So it's really not a true impairment. It's a, when we agreed to sell the Eagleford and the Arkoma assets, we entered into those purchase and sale agreements in November. The
Okay.
deals did not close until January 30th. So we crossed.
Yeah, crossed quarter.
We crossed a quarter end. So the Arkoma asset, had, what we sold it for was less than what the book value was. Doesn't mean
Mhm.
that we got a crappy price for it. It just means that,
Yeah.
because book value is different than market value, right? So that was sold at less than what book value was. And the way that held for sale accounting, the way that Ernst & Young does it, or the way it's really GAAP, it's not just
Yeah,
Ernst
right.
& Young. If it crosses a quarter, you have to effectively treat it as an impairment instead of a loss. If it had occurred in the same quarter, right? It would have been a loss on sale. Now, on the Eagle Ford, we had a gain that's pretty similar to what that Arcoma loss was, but GAAP accounting doesn't allow you to book a gain on or positive impairment, for lack of a better term.
I know, it's like
right?
crazy.
So what you would then see is the gain will show up as a gain on sale on the March 31st quarter for that asset, which then, when you blend the 2 quarters together, they offset one another. But it's one of those funky GAAP rules, right? That don't, don't make a whole.
There's many
what it
funky
is.
GAAP rules,
Yeah.
the SEC rules, and I'll just tell.
But all
any
of that
you,
is non-cash.
any
to
of
your
you
point.
any of you that are new to this industry, just realize that SEC and GAAP accounting rules for upstream companies, especially, create very misleading quarterly results. Like, if you would have if something happened in the gas market and the price jumped to $10, they would have to book a big mark-to-market write-down on their hedges. And so it would distort the quarterly results for the first quarter. It's just, it's crazy. And all I can say is focus on operating cash flow, free cash flow. That's how you want to value these companies.
That's right. And book value, I
Almost
always
means nothing.
it means nothing, because in what GAAP accounting in oil and gas says is that you can never mark it up. You can, if prices go down, you have to write it down. But if prices go back up, you cannot write it up.
Yeah. And let me tell you something. In our Sweet 16, every one of our Sweet 16 companies is operating cash flow, and not only operating cash flow, they're free cash flow, and they are generating tremendous profits. And I think 6 or 7 of the companies are trading below book value.
Right.
That's insane.
Yep.
You can't literally an upstream company should never trade below book value unless the auditors are not doing their job. Because if the assets were worth less than book value, you should have to take an impairment charge.
Yep.
So it's
Reserve
absolutely
value
crazy.
is a better reserve value is a better
reserve value.
strip.
Replace
measure book value.
Yeah, the thing to do is, if you take the balance sheet, take off the book value of the oil and gas assets and replace it with like PV10 or PV15, whatever you want to do, replace that, and you'd get a better idea of what the company is really worth. That's why that year-end reserve report is so important to do. So, well, Ralph, thanks a lot, man. This is great. It clarifies a lot of stuff for me on the company for sure. And I believe this is a growth company for us. That's why it's in our small cap growth portfolio. I look forward to some good quarters ahead. We got a big gain on the Eagle Ford sale going to be reported in the first quarter, so that's great. And let me know. We have restarted our luncheon program back in the Houston area. We actually have 3 luncheons coming up in April. And I think one's already booked for May. But if you want to get back on our luncheon schedule sometime, and we've moved back to our old location. We used to be in the Hess Club, and they went out of business in the pandemic and sold. But the new owners have really remodeled the whole facility, and it's really nice. And we used to get crowds there of 70 or 80 for some of the luncheons, so it's good. But anyway.
Definitely.
All right. Thanks a lot, Ralph. We'll go ahead and end it there. We recorded this. This recording link will be sent to all of our EPG members globally. Thanks a lot.
Thanks, you all.